but I've got to do my notes on that 4-hour session, or else it'll be gone.
I understand. Join us anytime, and we'll have a chat period at the end of the presentation. I think I've got a good show for everybody today, and I will remind that your favorite request is after the presentation, that and when Greg sends you an evaluation email, to please fill it out and get it on back to him.
Please.
That makes his job easier as well. Okay,
Thank you so much.
All right, the study guides that are coming to you are the one that's the talking points for our presentation today. Then there's another one that's titled 40 Main Street Smart Drill Skills. And what that is
I did send all of those out to everybody, Steve.
Very good. Thank you so much. Those 40 drill skills are, if you will read them and try to own them and understand them, 30 of them, I've got video presentations you can watch. But I have so many people that say, thank you, Steve, this is making a major difference in the way I'm thinking and the money I'm making, the way I'm doing my business. So let me encourage you, they're all quite, I want to say simple, but they're basic, fundamental ways of doing business and ways of thinking that can make a major positive impact for any entrepreneur. There's another handout about 20 businesses you can start with $100 or less, and I'll be giving a webinar on it very soon. Then there's another one about hundreds of different types of businesses, just to give you some ideas about maybe where you can find additional profit centers for the business you're starting or are already in. And then today we're going to talk about understanding depreciation, because that is such an important part of the entrepreneur's tax consideration. And that is a in-depth, detailed explanation to help us understand how depreciation affects us. Well, we're going to have two different kinds of themes today. One's about the depreciation, and one is in general avoiding tax problems and record keeping and things related to deductions. So just sit back and enjoy, get your notepad out, circle up what you want to talk about later. We'll have a little question and answer period after the presentation, as long as you'd like to talk, and or you can send me emails and request other items as you go. Before I get into it, I see we got quite a few more folks. Griffin, I'm so glad to have you, and Lee, glad to have you guys on board, and just everyone. We're so honored to be able to serve you. I want to tell you that this is my presentation number 954, so I'm well on the way to 1,000 in my journey of working with entrepreneurs, and so happy to say thank you for joining me on the journey. But more importantly, I want to thank you for letting me be a little part of your journey into small business. I've been at it for 63 years, and I have no regrets. Of course, there's been some stressful days, and there's been some delightful days, but you know what? I am more gratified and satisfied these last few years doing this type of work, online and face-to-face presentations, because I know you're in here to try to help yourself and your family go to a better place. And I'm just honored to be able to help you. And I can say on behalf of all the directors of the small business centers, they feel the same way. So let us help you. That's why we're here, and that's how we feel like we're accomplishing something. Now, that guide that I mentioned to you, the study guide, Understanding Depreciation, is something that I copied off the internet, written by Lisa Borga. I bet I looked at 25 different presentations that people had made, but Lisa had the one that I could understand the best, because when it comes to accounting, I'm not the sharpest pencil in the tray. I know that. So I kept looking. I found Lisa's presentation, and I want to recommend that if this is something, and several of you have mentioned that you're actually into the bookkeeping, and if you're into any type of business that buys a lot of assets and resells assets, or has a lot of capital equipment, you're going to need to really understand how appreciation can help you, because it's a big deal with how much taxes you have to pay at the end of the year. So let's start off talking about that. Depreciation, the definition, a reduction in value of an asset with the passage of time due to particular wear and tear. So assets are the physical things that we buy and own in our business, and they're quite expensive. And the key is that we have to put them in and out of our books in such a way that it doesn't kill us tax-wise, or on the other hand, doesn't kill us showing we've got too much debt, or that we're not getting upside down with our loans. So understanding how depreciation works can help you spread out your cost and spread out the benefits of owning new stuff over a period of time instead of taking one big lick on the chin if that's what you have to do without using depreciation. So let's just kind of start out using some examples. I don't want to dwell on it too much, but it's important that you have an understanding of this, because at the back end of this presentation, you'll see that depreciation had a major difference in what your tax situation is, and maybe more important, how your financial statement looks. So let's say that today you're first getting started and you borrowed or you saved or you got through a loan, or in some way you got $10,000 in the bank. So, and that's what you got. That's it. So your company net worth today is $10,000, and that's all cash and it's all in the bank. So your asset is in the form of cash. But you're ready to get started in business, and let's say that you're excuse me, that you're in the nursery business, and you need to buy a transporter, some type of power type tool to use in the nursery business, or a saw, and it's going to cost you $5,000, and you need it. It's going to make you money, so you're going to go buy it. So when you buy that saw at $5,000, your cash is going to be reduced down to $5,000, right? You had 10, you used 5 of it. So the first question to you this afternoon, after you buy your saw, does your company net worth go down 50% to $5,000? I mean, you used up that asset and it's gone. Well, the answer, of course, no, because you still have that saw, but it don't show up in that cash account, right? That's why we need a bookkeeping system, and that's why we need depreciation, because now your company has $5,000 in the bank cash-wise, plus it's got that brand new saw that's worth, now here's important, today, that brand new saw today, because it's still new, is $5,000, so your company worth is still $10,000. Pretty simple so far, right? But the key word is that saw is worth $5,000 today, but as it ages and as you use it, it's going to have less value because we're using up the value, right? Now, we are considering how much of that $5,000 we can write off. Is that a write-off expense? And when we're talking about writing off, we're talking about deductions. So getting back to our main theme of taxes, everything that has to do with depreciation has to do with deductions. Now, this is one of the first times I've given this presentation with the entrepreneur classes, because in my business and hearing other people talk through the years to class members, we didn't ever talk about depreciation. So there was a lack of understanding about how important it is that you do buy things when you need them, and how it will affect your end of the year bookkeeping and the advantages and disadvantages. So writing off and using your purchases as deductions is really important. So let's say we have a 5-year write-off plan, which would simply say that each year we're going to write off $1,000 or take a $1,000 deduction, you might say, based on that one saw purchase. But as we take those deductions on our books, the value of the saw will start decreasing $1,000 each year. So at the 6th year, it's not worth anything. It's still on the books and you still own it, but it's not showing a value because we used up all the value by using up the depreciation. With me so far? If you are, say yes, sir, or amen, or something or another, because that's what we're doing. We're talking about how we write off and take deductions. So our tax exposure, we're going to pay taxes on how much money we have left after we use up our expenses and our deductions. So the more deductions we can take, the more depreciation we can take, the less amount of taxes we're going to have to pay at the end of the year. So as we took those $1,000 depreciation deductions off of our depreciation sheet, we were also saving or taking $1,000 off of our taxable income at the same time each year. So over a period of time, that $5,000 that we spent today, cash money, we were able to get that money back in a sense by using tax deductions through the years. That's why it is good for businesses to buy things. It's good. The government, the tax rules have set it up to encourage business people to buy assets. If they didn't give you these tax deductions, it would be a major disadvantage to buy expensive equipment. So now let's have some theories now. After 3 years, let's say your saw was stolen or destroyed some way. And at 3 years old, you had it on the books for $3,000. Okay? Now, because it's worth nothing, do you need to take that off the books? Well, you have the option to take it off, because how you enter and take things out off of your depreciation list, you got a lot of freedom there to do what you need to do. So some people would say, I want it off and be done with it. But other folks would say, I'm gonna keep that old saw, or I'm gonna keep my records on it. And I did purchase it, and I'm gonna leave that on my books and keep taking those deductions for another 2 or 3 years and let that serve me as an advantage, even though the saw is gone. So we'll come back to this type of thinking a little later. Now, after 5 years, though, let's just say that we used it up and the saw did good work to you. But after 5 years, you had taken your depreciation deductions and it was down to zero. The value on the books was down to zero, but that old saw is still cutting. It's not worn out. It's still working, and it's still worth $3,500. But it's showing on your books zero. And this is where you learn the important lesson that there's a major difference in book value and fair market value. You could have some real valuable assets that you own in your business, thousands and thousands and thousands of dollars, that might have a goose egg beside them on the depreciation list because you had depreciated them down. So when somebody asks you what the book value of your business is, the book value, that means how does your depreciation numbers add up? But it's also the place that I'll say here that so it's so important for entrepreneurs. The fair market value of your business and the book value of your business are two different animals altogether. And so you always want to look at what your assets have a fair market value posted at versus the book value. We'll talk about this a little bit more too. So let's say that you had that saw, it was zero value on your books, and it was fair market value $3,500, and you decided to sell it. Well, if you sell it when it's at zero value for $4,500, then here's a problem, in that you don't have to say that you sold something that you had zero money in for $45,000, and your tax exposure would increase by $4,500 when you sold that asset. But let's say that you sold that asset for $100. Then your tax exposure would only increase $100. And you've got the power as a small business owner and entrepreneur to sell your stuff who you want to do it to and how that plays out. So if you wanted to sell it to a friend or somebody and give them an extra good deal, or y'all worked out an arrangement that what happened after your sale, you might benefit from it. You've got a lot of flexibility here to save your company from having to pay extra taxes. A lot of gray area here, a lot of places that you can slip and slide if you're not careful, but there's also a lot of places that you can create some cash income. After 5 years, you still got the saw at book value, and the fair market salvage value is only $10. then I don't suggest you take it off the books. You just get rid of it, forget about it, and you can do that with no questions asked. Now, let's say that your taxable income exposure is $80,000. You've had a good year, and you're working through your books, and it looks like now that you're going to have to pay taxes on $80,000, and you've got some purchases that were worth $45,000. Well, in a year that you might want to decide that you're going to do 100% write-off, and sometimes you have that option, depending on what Congress is doing for you, and this is always changing. Every year there's changes in how fast you can write off your purchase of assets. So let's say in this year they're giving you an option to write off 100% of new cars, or 100% of new farm equipment, or 100% of new appliances or solar panels or things like that. And it changes the tax laws change depreciation-wise almost every year with different things. So your accountants don't have to keep you posted on what you can do. But let's say you had the option to write off 100%. That means that you could reduce your taxable income from $80,000, subtract $45,000 from that, or reduce it by $45,000. Or maybe you decided that you were going to write it off over a 3-year period. Then this year you would reduce your taxable income by $15,000, or 5 years, $9,000, 7 years, $6,000. So the point is, we need to be aware of what are the deduction options you have. You want to know that before you make any major equipment purchases, so that you'll have a good idea. Maybe it's not, this is a high price and I'm paying a lot of money, but when you talk to your accountant, your tax advisor, maybe that price will look a lot better when you consider if you're going to be able to write a lot of it off. This will always come into play when you're having a very profitable year. If you're having a sorry year, you know you're not going to be showing much gains, then that you may want to revisit and rethink your logic here. The old saying is, and we hear it all the time, and you've heard it before, I'm sure, you have to spend money to make money. And that is very, very true. Especially it's true in advertising and marketing. It's very true when you're investing. And it's super true when you're taking advantage of hot deals. But you got to be careful. And old Papo Steve-O here, who my grandchildren call me sometime, I want to tell you, spending money to make money is a firm, good rule for entrepreneurs, but here's the caveat to that. If you're using this logic as a reason to go purchase new equipment to avoid paying taxes, I want to tell you that it's probably not a good idea until you really check it out, because maybe you're thinking you can take 100% deduction on something and save a lot of tax money come January. But if you hadn't checked up with your accountant and the depreciation consideration, it may not be the case at all. That's right. It may be a very bad move, and you may be getting a surprise at the end of the year that you really didn't want to have. So spending money to make money, yes. But I got to put a red flag up there. You always got to double check with the people in the know when you use that excuse to go buy something really expensive that maybe you've got the option not to buy it. Now, let's go back to that $80,000 estimate tax exposure, and your tax rate is projected to be at 23%. At 23%. So you're going to pay $18,400 in taxes based on that 23% tax rate. But when you made that $45,000 deposit or purchase that we talked about just a minute ago, then your taxes would go down at 100% write-off to $8,100, or instead of $18,000. Or as you go down with writing it off over a longer period of time, you see what happens to your tax exposure. That's why I wanted to talk about this, is because so many entrepreneurs that are brand new to business do not understand that when you buy new assets, you have a way of recouping that money as you go along, provided you're being profitable. And that's the big if, isn't it? Provided you're being profitable, because it will help you keep some money in the business instead of having to send it to the government. So again, right here, talk to your CPAs. Make sure that your tables and your options, you know what you're dealing with current laws that are being passed in Congress. Do not make any purchase decisions based on trying to save taxes without talking to your PCA. Now, I want to say that again for you. Do not make any purchase decisions about buying assets to save tax money without talking to your CPA. And I don't care if you've been in business for 2 days or 200 years. This is a rule that's a good rule for you to follow. Let me tell you who not to talk to and get the advice from. It's the salesman, first of all, that's trying to get you to make the purchase, because he's interested in selling the equipment. And it's certainly not the guy down at the bar or the restaurant who seems to know everything about everything else. Because whoever it is, if they're not doing their homework like CPAs do, there's a reason we call them certified public accountants, and that is because they're certified to keep up with current laws. And we do need to talk to them. It's kind of important now we talk about that, because we're in an inflationary short term right now. People that are starting businesses that need pickup trucks or dump trucks or tractors or lawnmowers or different stuff, pretty big expensive asset items, and the prices are just going up and up and up on them. So a lot of salesmen are telling you, go ahead and buy this now, you'll get it all off on your taxes. That may or may not be the case, because some things you can depreciate and other things you cannot. Okay, where does depreciation apply? It's important to us when we're talking about the large tangible items that we purchase. Because when we purchase a tangible item, we're going to start calling it an asset. And our assets are always show up on our books on the depreciation sheet. Large tangible items could include real estate if you're buying that real estate to rent it. If you're buying a house to rent out to someone in the future, or a commercial building, then it's an asset that you could depreciate. If you're buying real estate to use as your own business, not to rent it, but to use it as yourself, then it wouldn't be depreciated. It would still go on your books, but it wouldn't be something you'd be depreciating in a certain way. It wouldn't be on that depreciation item where it's coming down each year. Furniture and fixtures, manufacturing machinery, computers, telephone systems, your shop or your trade craft tools, vehicles and trailers, lease. Even if you're renting property, the investments you make in the property you're renting, they're called leasehold improvements. They're items that could go over on your depreciation list. So sometimes people will stay in the rental property they're in because they got a real good rate on it, and they say, I'd really love to fix this place up, but my landlord won't pay for it. Well, the news is, if the property is good to you and it's profitable for you, you can spend money on rental property to improve it, to put new offices in, or bathrooms, or a showroom, or put fences up, or pave the driveways. You can spend some big bucks on it. Of course, you don't want to talk with your landlord to make sure you're going to extend your lease and he's not going to go up on the rent on you and things like that. In other words, you make it plausible. But those monies you're spending, you're going to be able to list those on your depreciation list and get some tax advantages from it. So it makes it a lot easier for you to improve those rental property. Items that are not going on that depreciation list are not going to become anything that you'll be saving tax money on, or things like that are non-tangible items. Non-tangible items might include your website, which I know I spend a lot of money on that. Other disposable items, printer paper, low-value items, cleaning supplies, items that have short life values, a gallon of gasoline, leased and rented properties That is stuff that you're renting yourself. You can't put on that someone else owns. Well, you can't put that on your books and depreciate it. The people that own it can depreciate it, but you can't. Service contracts, anything related to service, because that's non-tangible, or just your regular monthly bills. They wouldn't apply here either. Remember now, depreciation is all about the reduction in value as an asset starts to wear out or wear and tear. Its value goes down, and you want that to be reflected on your books. Depreciation starts the very first day that you purchase something. So when you put things on the books, you're going to want to document it. Therefore, record keeping is going to become important here, so that you can document when you bought it and how much you paid for it. And then the scale starts, depending on how much use you're getting out of it, how much money it's making, how fast it's wearing out. As that scale goes over to the left here, that means that the value is going down over a certain period of time on your books. Maybe the real value of it's falling a lot faster or a lot slower than on your books, but when you put it on your books, it'll stay there and you can't change it for later on changes. So those decisions are important. When does the depreciation consideration end? It ends when you have depreciated it all the way off your books and it comes down to a zero or to a bare bones salvage value. Then it becomes a non-consideration. So this is where I would put in and recommend to you. You probably don't want to put every little thing that you could possibly claim to be an asset into your books system, because you're always going to have to keep up with it. People usually do, and I certainly do, try to keep my depreciation list, the list of my company assets, at least in a manageable number. Now, of course, I'd like to have 15 or 20 sheets full, which means I'd be worth a whole lot of money that I'm not. But the 15 or 20 items that I do have on there, that's good. So sometimes you're better off just to write off something as soon as you can rather than have to deal with it on your books for a long time. But again, different businesses may have different strategies depending on what's important to them. One of the things that people will consider, the more assets they can show on their books on their depreciation list, improves their financial statement. And if you want to show that your company is worth more money, one of the ways to do it is to have more tangible assets on your books. Of course, always have more cash in the bank and always have less debt or less expenses that you have to be showing. But keeping items on your books as tangible assets is a good way to show more value on your financial statement. When is that important? It's important when you're trying to borrow money. It is. It's important when you're trying to borrow money. But the other side of that is the more tangible assets that are on your financial statement, the more county taxes you're going to have to pay. So that's the two-edged sword too, and we'll talk about that a little later. Things to remember. Take a look. Depreciation helps you move assets around on your company statement. In other words, you have some flexibility on your cost and where you put it in on your financial statement and the values that are shown there, depending on how fast or slow you write them off. But those taxable assets have to be taxed. And for the entire, talking about county taxes now, for the entire time that it's on your books, it's the way that you're going to be able to account for them and pay taxes on those assets. The depreciation ties the value of using the asset against how long is its life. So when you're making the decision how long will you depreciate, you're going to be asking yourself, well, how long is it going to last? If it's going to last a long, long time, you might put it up on a longer depreciation period. And there's lots of different types of depreciation, because we're looking at this from 20,000 feet instead of right down close. When you actually examine every type of depreciation option you might have, and there's a lot of them your tax advisor can talk to you about, it may give you some more options that I don't know about and I won't even mention today. Most of what we're talking about today is straight line depreciation, and straight line means we got a certain amount of money we're taking off each time. we're not getting into amortization or other things that are related to debt this afternoon, because that can get even more complicated and require special consideration for each individual situation. Now, we'll hear about the term accumulated depreciation, and that is the total of the appreciation that you take on all your assets. So over on the front of your tax filing statement, there'll be a line that says accumulated depreciation, and then it will refer that you go back on your tax statement to another page. But there will be a page there where you took a certain amount of depreciation on each and every asset that we've discussed today. A little bit here, a little bit there, a little bit there. They will total up at the bottom, and whatever that total is the accumulated depreciation, which goes over towards the front of your tax reporting form, and that's the number that is deducted from your taxable income, that accumulated depreciation. And sometimes that can be a lifesaver for you. Now, the carrying value of assets on the balance sheet of your financial statement, where you get a good look at your at the valued asset, because it's going to tell you what you paid for it, and it's going to tell you your current depreciation. So as you get into doing your books in a business, this depreciation sheet is going to be a very interesting sheet, and I want you to understand it. Yeah, it's just easy to give it to the CPA and say, you figure it out. I don't need to know about that. But my friend, you do need to know about it. You do need to know how your purchases are affecting your tax payments, because it may have a lot to do with slowing you down or encouraging you to add assets to your business. After a while, after all the depreciation is taken, do you want to carry it on your books at a salvage value or not? So you've got some flexibility there. Oftentimes, it's a good idea to keep it on your books if you want to show more value, because you can say this has no value salvage-wise or book value, but you can always put footnotes in your financial statement. And let me just mention that now. Let's say that you've got a lot of assets that are showing zero or very low balances book value, but you can have a footnote to your financial statement for your creditors that say, my book value is $10,500, but the fair market value of these assets is $250,000. And that'll make a world of difference if a loan officer is considering loaning you some money. So you need to know this. Your financial statement is not going to reflect that fair market value, which is a disadvantage to them, unless you put footnotes on them. And footnotes are very important when you're doing your financial statements. Now, a reminder again, let's say you're thinking about buying a business. You want to go out and buy an existing business, and that's a good way to get started in business. And maybe the owner is offering to sell to you what the business book value is. Well, oftentimes that book value may be far below what the real fair market value is, and you might get a great deal of doing that. But here's the other side now, my friends. People play games with book values and fair market values. And they'll put something on that's very, very expensive and fail to write it off. And so by the time you are there, on the books, it's showing that it's worth a whole lot. But when you compare it to fair market value, it may not be. So that's where someone that's smart and experienced is going to say to you, you never take those values at face value until you do your research and make sure you know what you're talking about. There we go. Got some background noise. Who cares? I mean, Steve, why did you do this? Who cares about depreciation? Why have you got this? Why have you got us at 2 o'clock in the afternoon on a Thursday talking about depreciation? Who in the world cares? Well, there's 4 or 5 groups of people that care. I want to talk to you about each one of them. Your creditors care very much because they want to see how you've been spending your money. And they want to see how the depreciation is affecting your actual ability to repay them. And oftentimes depreciation here is a very positive thing for you, because you may not be showing that you're making much money or paying much taxes, which is saying, oh, they're not making much money. But after they'll take the time to look at how much you've written off depreciation-wise, they will appreciate your efforts and say, okay, if they hadn't had all this depreciation, they would have had to pay a lot of money because they had made a lot of profit. So your creditors will really take a good, strong look at that. Very positive in tight times. It can help you. Your CPAs don't care about it very much, kind of from a selfish reasons, because they got to figure all this stuff out. They get to calculate it and do the amortization charts and have conference with you and talk about it. So the CPA really cares about depreciation because it is a way that they make more fees on your doing your books for you. So the more things you have to depreciate, I don't tell you, each and everything you add to that list means that your accounting bills don't go up a little bit. The IRS really cares about depreciation because it affects your taxable income. So it's a big deal with them as well. The county tax collectors maybe care about it most of all because everything that you're going to pay your local county tax-wise, or almost everything you're going to pay them, is going to be based on property that you own, the value of your assets. And so how they're depreciated, and it's the depreciated value, the book value that you pay county taxes on. So they don't care about it very much as well, and a good reason for you to think about it. But who cares most? I want it to be you. I want it to be you, and that's why I wanted to have this as a part of our presentation today to give you insight on a major factor into your tax liability. So we're going to work now into avoiding tax problems. Record keeping, deductions, audits, just general avoidance and evasion talking. And so let's move into that now. Remember, let me encourage you to, on your chat board, is to type in your name and your email address. Tell me what kind of business you're in. Ask any questions that you might have, and we'll try to answer them after we close this afternoon online, or I'll send email answers to you. If you want to have questions with Greg, can see the chat as well, and we'll do whatever it takes to get you the information that we can to help you. When I talk to accountants about what is the number one thing I need to mention to folks in my webinars and seminars to help them related to avoiding tax problems. And you know what? There's always the same answer from any accountant that I talk to. Every CPA, and I've talked to maybe 8 or 10 of them with this question, come up with the same answer when it says the number one problem. And that is, entrepreneurs seem to get surprised in a hurry because business gets good and you get involved in doing business and you start taking in money and paying your bills and buying things, and then all of a sudden you've got tax payments due, but you've used the money up and it's not there to pay the tax. And therefore panic comes in. You have to figure out where to borrow the money or raise funds or sell something, liquidate it, or end up having to pay taxes and penalties. How do you not get in that jam? Well, every one of you that's getting started, or every one of you that's still facing these issues, the way you do that is, as you start receiving money, you pigeonhole it. You take that money and either in an accounting practice, keep it to the side, don't use it, take whatever safeguards you have to do to put that money in a special account or a special place in your books so that it is there when it's time to pay the taxes on it. If you do that, you're not going to have the big surprises. And what are the big taxes that surprise people is if you've got employees, it's withholding taxes and workman's comp. If you're selling a lot of products, it could be sales taxes. So you've got to be careful. Now, a tip that I'm going to offer to you is that if you're in a business where you bill people in advance and then you have to wait for them to send you a check, it's a good idea not to put invoices that are related to tax payments where you're collecting sales taxes. It's a good idea not to actually put that invoice into your books until after you get paid. It's okay to do the invoice on paper and send it on to your customers so they can use it to pay you by. But when you enter it into your books, let's say that let's say you're doing a deal today, March 31st, and there's a $800 sales tax thing related to it. You sold something that you don't have to generate $8,000 in taxes, so it was a big deal. So you log it in your books on March 31st. Well, let me tell you, those sales taxes are going to be due about by the 10th of next month. But maybe you're not going to actually get your money back for another 30 or 40 days. So that puts you in a jam. Because you entered that deal on your books 1 month, it's going to be paid immediately at the end of that month, whether you've been paid or not. So you'll be more wiser to send a advance invoice onto your customer to use as a pay stub, but you don't actually write it up and enter it into your bookkeeping system until you get paid. Now, sometimes that causes some problems and some issues because maybe there was a commission salesman involved and he wants to go ahead and get his commission and things like that. Well, here's the deal with that. Starting right now, you just go ahead and learn that you don't pay commissions to anybody until you've actually been paid as a company, because things can always go south. People change their mind. People die. Companies close down. Some go into bankruptcies. People change their mind. So don't put business in your books, especially if they've got some significant tax issues to them, until you've actually been paid, and that'll help keep you away from a jam. Let's talk about record keeping a little bit, because everything related to taxes always comes back to record keeping, so we need to talk about it some. Some records you just have to keep for a long time. So it's important we talk about how are you keeping your records. You're just getting started maybe. I want you to know about flash drives that you can plug into your computer and download all kinds of stuff on them. I want you to know that there's companies that will automatically come into your computer every night, or 2 times a day, whatever contract you set up, will come in and back down and save all your information automatically. And then we got different types of storage that you might use, be it paper products or other things. And it's amazing, these computers were supposed to do away with all the paperwork, but they actually increased it. So if you're using outside storages, make sure you've got a place that's high and dry, and you've got a good system, and you're taking care of these records. Because after 63 years in business, I can tell you that every week you'll need to go back and find some type of old record to help somebody that's asking you a question, and you're going to need to try to help them get started. That's some other mics to mute here. So good to have some more folks to come on board. We appreciate you being with us tonight or this afternoon. Okay, there's some records you don't need to keep forever, permanently. They're listed on your screen here as articles of incorporation, accountant audit reports, copyrights and patents, capital stock, and mortgages and deeds. I read a lot of these slides because there's several of you that do not have access to the screen. I see this usually sometimes when folks are calling in on their telephone, all they can do is hear the audio part. That's why I want to mention to you that if I have your email address, tomorrow I'll be able to send you a recording of the presentation, and that way you can replay it and actually see the slides again if you'd like. Other permanent records includes depreciation, year-end financial statements, license and permits, all your tax returns. You want to save your tax returns because sometimes if you're working on a loan, you'll have to pull out 5 years and show the creditor. If you're into doing trademarks, you want to save those records as well. However, 7 years is the norm for most of the bulk of the business records that we'll need to keep. And there's a long list of those that we need to keep for 7 years. And while it's official by law 7 years, on my system, I use 8 years because I always know that each year after the year ends, I'll get some late stuff come in and I'll put it in the current year's box. So I save my records for 8 years. 2 of these different types, and with bank statements are important and so many others, are bills of lading. And you may hadn't heard of a bill of lading, but what that is a proof of shipment. If I'm shipping an implement to someone in Texas tomorrow, the freight company will do what's called a bill of lading that shows they picked it up from me and delivered it to them in Texas. It's important that we save those copies with our invoices, because in a lot of situations with a lot of different products and a lot of different states, you may not have to charge sales tax to someone that you're shipping products out of state to. That's right. Since they didn't buy it in North Carolina, it's not a North Carolina sale, therefore we don't have to collect North Carolina sales tax. But there's some situations that are different, not only with different types of products, but also with different states. So that's not an ironclad rule, but there's a lot of that that's happening in today's world. Bottom line is, if you're not adding sales tax to your invoice, then you need to have a statement there so that you can identify a bill of lading or a proof of shipment somewhere along the line, because if you have an audit, they're going to want to see those documents. If you don't have the documents, you may have to pay the tax, even though you didn't really have to collect it. You may have to pay it if you can't prove that that equipment went to someone out of state. Now, employee personal records are important also that you keep. Even after they have left your employ or been terminated, you want to keep all employee records pretty much at least for 7 years, but I like to keep those for even permanently, maybe, because at some point in time, someone that once worked for you may have a problem, and they go to the doctor and say, in the doctor's office always will quiz them, just like they do you and I. Well, how did you get hurt? And if they say, well, this started back when I used to work for Steve, well, they will automatically put, now what was the name of that employer? They'll type in Carver Equipment Company. And then their unemployment compensation would be paid out of Carver Equipment Company's account. That's right. No matter how long ago it was they used to work for, if they say they got hurt on the job when working for me, then I'll have to pay that bill. So once I get that notice that they're charging my account, if I have some records to prove that it was a long time ago, and or when they left my employee, they signed a sheet that they hadn't been hurt on the job, and that record right there that I saved will keep me from having to pay that bill for them. Now, I want to pay the bills I'm supposed to, but whoever else that person's working for, or whoever else they got hurt, ought to pay that bill, because when my fund or when your fund is emptied, then your taxes are going to go up immediately each month for your employment compensation payments. So it's important you keep up with those kind of things if you've got employees. Sales tax records, important. All your invoices, cancel checks, and things like that, 7 years. Little side note here. We're in an area that has thunderstorms and floods and tornadoes from time to time. We're in an area that has hurricanes, right? So we have droughts with our farm customers. So FEMA, the government organization FEMA, oftentimes will come into an area after it's been declared a disaster area by the president and offer small business people loans or grants or special interest situations to help them recover profits that they lost. So when you're making that application, they're going to ask for you to prove that you were making money, so they'll have a basis to reimburse you. So if you've been creating your bookwork in such a way to show that you're not making any profits, and something like that happens, then you're not going to have any proof that you made any profits, and therefore you will get no consideration for someone to help you recover your profits. That's also true with insurance claims, because a lot of us in small business have loss of profit, loss of business coverages as one of our risk management factors. Well, you don't have to know that that'll come home to haunt you if you have been fixing your books to show you haven't been making any profit, because the insurance company is not going to pay you money for profits that you can't prove that you had been making. Keep that in mind. Let's move our topic now to expenses and deductions. I mean, we're right here on March 31st. Is there anybody who has not filed their tax forms yet? I see some head shaking. Got a few more weeks here, right? So always the two most popular topics are expenses and deductions. So let's get into it. I want you to know that there's two types of expenses when we're talking about businesses. One we're going to call a regular business expense or operating expense, and another we're going to call it a capital expense. Now that whole part, that first hour we talked about depreciation, that was all capital expense type items. So when you capitalize one of your purchases, that means you have decided you're going to call this purchase an asset. And from there on, we're going to refer to those as capitalized expenses or depreciated type assets, okay? So let's determine what the difference is on those and go through some examples. Let's say that the business expenses are those costs that you just spend when you're conducting a trade. When you're renting the storefront, the rent that you pay, business travel expense, the payroll for your employees. Those are business expenses. They're not deductible. I mean, they are all deductible, 100%. So it's a total write-off, but they're not have anything to do with depreciation, or we're not going to call them a capital asset. Capital expenses are those items that have usually a life of a year or more. They're items that you'll call an asset that you may depreciate or amortize or have some depletion issues with them. So capital expenses just come into the tangible items that have a long-term life and usually a pretty significant value that you want to call them an asset. Examples-wise, let's say that we're going to talk about a printer here. When I buy a $250 printer, like I've got one right here beside of me, it will probably last me 5 to 10 years. So even though it's a fairly low amount, I want to show some value in my business, so I would put that printer on my books. I would, and I will probably depreciate it off over a period of time. However, if I was a large insurance company and had 5,000 adjusters out there traveling all over the world, and every one of them had a $250 printer, I'll guarantee you I would not put that printer on my books if I was going to have to put 5,000 of them on there. I would consider those write-offs, right? So every business, every situation will have the freedom to look at this and decide whether you want to write it off or put it on your books pretty much across the board. Now, new printer at $2,500, pretty much anyone would say, okay, I don't keep that a long time. I'll probably depreciate that. I'll put that on my in my assets, call it a capital expense. Would not be able to write it all off unless I had some particular reasons to do it. But now the printer paper that I bought for either one of those printers, that's an expendable item. So it's definitely just regular business deduction. It would never end up on our depreciation sheet. A $2,000 set of tires for me and my business would last me a long, long time. I would put those on my books. But a large trucking company that has 10, 15, 20, 100 trucks on the road and they're buying these expensive tires all the time, they just write it off. A new engine for the truck, a large trucking company write it off, where I'd write it on my books. I'd keep it on there for as long as I could and try to get some tax advantage out of it. Renting a forklift, always remember, if it's rent, it's just a regular business deduction because you can never capitalize that. Payroll, the money we paid at CPA, a $4,000 set of shop tools. Payroll, out of here. CPA fees, non-tangibles, out of here. Total write-off, 100%. That set of shop tools is going to hang around a while. It's going to last a long time. It's going to hold its value. I would put that on my books, and I would write it off and use it as a tax advantage for as long as I could. And also, it will help raise the value of my company by having it on the books, because it would depreciate very slowly. But who buys a $4,000 set of tools at one time? Very few of us. So here's what I'd say to you, depending on the business you're getting into. Maybe you're buying $100 this month and $300 next month and $25 the next. But at the end of the year, because you saved all your records in record keeping, at the end of the year, you pool all these tools that you bought together, And if they would be considered a tool set, you add them all up, enter them into your books under one number, $4,000, and then you could use it as a write-off. But you want to have them in a box so you can put your finger on it. Here's a little footnote. Anything that goes on your depreciation list, the county tax people may come by and want to do an audit. So you want to know where that asset is in your business so you can put your finger on it and show it to someone if you ever get audited. That's right. You may be held accountable like in every other type of business arrangement. You want to know where those assets are. Also, if you're trying to sell your business and the buyer is looking at your financial statement, one of the first questions I would ask if I was buying a small business is, show me these assets that you want me to buy. How about a monthly $100,000 a month a forklift rental? Nope. Rent is a deduction, 100% write-off. How about delivery cost? Nope. Got to write it off. But let's say that we worked out a deal to rent a forklift for 24 months. Paid them $24,000. But also I did it on a rent-to-own plan. A rent-to-own plan. And they agreed that if I rented it for 24 months at $1,000 a month, they would agree to sell it to me. So I would take ownership and stop paying rent for $5,000. All right, well, here's a great example of how we can see how these numbers will change. First of all, we wrote off the $1,000 a month. Every month as a direct write-off, 100%. But when we bought that forklift for $5,000, it went onto our books at what value? Did it go on the books at $29,000 because that's what we had bought it and paid into it, right? No. It goes onto our books at $5,000 because that was the actual money we used to purchase it. Exactly. So this is a good example that as you're getting started in business, maybe you don't want to show on your books you've got a $29,000 debt as if you were going ahead and buy the forklift up front. But if you did a rent-to-own plan, on your books you would just show you had a $12,000 debt at $1,000 a month because you only show 1 year's rental as part of your expenses on your bookkeeping system when you're leasing or renting. You just put down 1 year's value. However, so that makes your financial statement looks better because instead of owing $29,000, you only owe $12,000. But at the end of the deal, you're going to end up with a $29,000 forklift on your books at $5,000. And with a footnote, you could easily say this forklift is still worth $24,000. So you had the best of both worlds here. You had the write-offs when you needed them, provided that forklift was paying its own way. And you've got an asset that you can keep on a while. And you can always have your footnotes to encourage a lender to loan you more money because you've got more collateral or more value. So let's talk about doing those taxes a little bit, okay? Suggestion number one, if you're just getting started in business and you don't know much about bookwork at all, the more experienced persons that you can hire to bring on board to help you, the better off you're going to be. Try to find a bookkeeper that has done some other bookwork like you're doing. Try to find a CPA that's experienced with doing books for your type of business. It's more important, of course, to have a good experienced CPA, even if they haven't been involved in your type business, because you don't become a CPA without going through a training period with an accounting firm. So you build up a history of doing prior business. But if you're just shopping in the blue, one of the important questions you want to ask the bookkeeper and your potential CPA is about the experience they have with helping people in your type of business. Now, this is the place that I have to get on some touchy subjects here, because I want you to know that a lawyer and let's talk a little bit about two words that are very seldom talked about in webinars and seminars, but after being in business as long as I have, I know it's important that we do it. Tax avoidance is one thing, and tax evasion is something else. Two different words, and you've heard of both of them, at least tax evasion often. But tax avoidance is as legal as it can be, and it's a good thing for you to do, because if you don't do what you need to do to avoid paying taxes, then there's enough laws out here, different ways that they can collect, that it'll eat up every bit of your profits. And I'm not saying you need to do anything wrong here. It's just be aware of the different maneuvers and adjustments and way that you can conduct your business to collect more tax, or have to pay less tax, or be able to take more depreciation and more deductions. And that, doing all that together is avoiding paying taxes, and that's very, very legal. So don't think that it's not. But what is very illegal is tax evasion. And that is when you just flat lie or do illegal things to dodge and run from your taxes, make misstatements, or present things that are totally unethical. So tax evasion is a bad thing. Tax avoidance is a good thing. And just make sure that you know the difference and stay out of trouble. If you have a question that you're really concerned about, then you need to talk probably directly with your CPA and nobody else about it. So let's talk about the hot buttons that are usually come up when these discussions happen about deductions. Because every one of us is interested in taking as many deductions as we possibly can. Home office deductions, travels and meals, use of your car, interest, all these different things. So let's just go through those just a little bit if you'd like. What I want you, first of all, let's talk about home office deductions. The old school thought is that if your office is in your home, whatever percentage of the space that your office takes up, then that's the percentage of the expenses that you can take off as a deduction. Example, real simple. You got 100 square feet in your house and your office is 10 square feet. That means that your office is taking up 10% of the house. Therefore, all the house costs for maintenance, utilities, this, and that, you would add up to $100, then you would be able to take a $10 deduction as a business expense. And of course, those numbers would get real big and such as that. But let's say you just got one room in your house, or two big rooms, a big open space, and you've got 3,000 feet in there, and you want to claim that all 3,000 feet of it you use for office because it's an open space. Well, you're going to have some little problems with that, because the auditor might say, well, how big's your desk, and how much room you got for your clients to come in? And then they're going to ask questions like, do you have a separate bathroom for your clients? So how do you really call this an office? Or do you have a separate entrance for your business folks to come in, or does the whole family come in and out the side door? So depending on the mood and what the auditor's after, you could get some questions that make you squirm. How do you avoid that? The best way to avoid it is have an outside office. Have an outside building or a detached room from your house that you can say, this is it, there's no doubt about it. You got a door to go into it, you got a shop door, and you can keep up with those expenses fairly easily. The great news is, if you've got an outside building, you as an individual can rent this building to your company. Individually, you own that as a rental property. It would be your asset, not the company's. It would be your asset on your personal tax statement. However, on the company's side of it, it would be rental property that they're renting and paying you rent. Now, in my situation here, I've been paying myself $625 a month for the use of my office for lots and lots of years. I never had a problem with that. Plus my electric bills, my lawn care, my roofing costs and repairs and upfitting. So when you have an outside office, you can put a lot of expenses on it that helps you reduce your business cost. But the money that I pay to rent to myself, that is personal taxable income. Each month it raises up my taxable income by the amount of the rent. On the other side, it's a trade-off, because that rent is a direct deduction from the business side. So it is pretty much an even wash there. So just something to consider. But instead of you having to pick out how many square feet you've got here and how many square feet you've got there, and figure out every year that it's going to be a little bit difference. Just put a reasonable rental rate on your office and write out a rental contract, sign it both sides, and then you write those checks each month, and you've got a good paper trail that will probably help save you a lot of time and interest. The use of your car or your truck. Normally, if you just got one vehicle, it's not specialized, be it a pickup truck or a car or a trailer or two. Usually, you're better off to show ownership as an entrepreneur, as the individual, that you own this as an individual. The company doesn't own it. It's in your name as an individual. But you keep a log of all the miles and all the uses you do of that vehicle, and the company gets to reimburse you the cost of making that vehicle work for them. Now, in North Carolina, North Carolina, it is 55, maybe 55.5 cents per mile, I believe, is the fee. Some of you may be able to correct me on that, which means that if I log in 100 miles of business use on my vehicle, then the company gets to reimburse me $55. That's right. Just keep my log, put it into a system every month, get a reimbursement check, make my car payment, pay off my credit card, gas bills, and such as that. And I'll generally say that the $55 a mile, 55 cents a mile, is generally enough money to own and keep up a nice vehicle. Maybe not a brand new one at these new car prices, but you can keep up a good used vehicle, comfortable ride that'll get the job done for you. If, however, your vehicle needs are something special, depending on the type of business you're in, like a tow truck or a dump truck, or you need some specialized trailers, there can be situations where that really you're better off to go ahead and let your business own that vehicle, pay the taxes and insurance on it. Normally, your business insurance, you'll get a better deal on business insurance if the company owns the vehicle. If you got a whole fleet of trucks, like at my equipment company, we had 11 to 15 vehicles all the time. I was a lot better off just to put my personal vehicles right in there. And now, if I am, as an individual, am driving a company vehicle, then it reverses, put the shoes on a different foot. The individual driving a company vehicle, I'd have to keep up with the miles that I'm using it for personal travel and reimburse the company for all the miles that I was driving it as an individual at pretty much the same rate. But at any rate, you're paying your company back, and the companies don't have that money to help pay their bills, and you're going to use that as a cost for you. I don't think it's going to be a deduction unless maybe you were using that travel to take care of side business issues, another company you might have, another profit center that you're using for business. There's a chance that you can play both sides against the middle here and deduct it both ways. So have any questions about that, drop me a line. Let me give you an example of what you want to do, and maybe I can talk to you about it. Now, because of the glitches, I failed to tell you that I'm not a lawyer and I'm not an accountant, but I can give you some free advice. But the first advice that I'm going to give you is always get a second or third opinion on these type of issues. So taxes, insurance is an important thing that we need to talk about as entrepreneurs. It's important that those of us that are as young as I am and as young as you are, that indeed you have insurance policies that in case you die, that your expenses are paid off, or that your loved ones are protected, your children to get educated, such as that. So insurance should be on everybody's mind that plans to be around a while and cares about the people they love. Your business can pay life insurance policies on you and write it off as a deduction, 100% deduction, and pay for it with money that you didn't pay taxes on personally. The key is that when you write an insurance policy or have your agent to do it, that if the company is 100% down to 51%, the beneficiary, the life beneficiary of the policy, then the company gets to write it off. If, however, you're claiming yourself as the 100% beneficiary, or your estate then the company can't write that off. And you'll have, if the company pays that policy for you, your tax accountant will say you don't have to claim that as part of your income. But it is so important that that if you are concerned about this, that you want to talk to your CPA and make sure that if you want to add insurance policies to help yourself or such as that, there's a chance that your company can be paying for those. It's normally a lot better to talk to your CPA about that than the insurance person, because the insurance person is going to tell you what you want to hear. The CPA is going to tell you what you need to hear. But if you're going into debt as a business person, and none of us are guaranteed another moment of life, right? And if you should pass away due to an automobile accident or any other reason, you want to make sure that your family and your estate is not left with the burden of having to pay off debt that your business created. And you do that with insurance policies. Again, these are items that you need to, every individual's situation to be different, and you need to get good advice from 1 or 2 or 3 people before you make a major decision. Any money that you spend related to training or education, going to seminars, buying training books or online schedules, money that you pay for registrations, you keep up with all that. If it's related to your business training or education, it's a deductible. Keep up with it and claim it. Clothes that you're using in your business standpoint. So several of you have mentioned to me that you're in the types of businesses, it's going to be good if you wear some type of uniforms, or at least you're going to have your business clothes that get dirty and messed up and grimy, that wear out, have to be replaced on a regular basis, or maybe you have to take them to the dry cleaners on a regular basis. Those expenses related to your business are deductible. Now, me, for example, I had to buy a certain number of dress shirts and sports coats per year. Since the webinars, I hadn't to have so many pants, but the top part I'm having to replace on a pretty regular basis. So what I do is when I go 2 or 3 times a year, I'll go shop, buy a sport coat and some shirts. I keep up with those individual bills, and at the end of the year, I will claim those as uniform deductions because it's part of what I have to do in my business. So keep in mind, maybe you're not doing that. Any subscriptions like the special books or training that you take related to your business, you can claim those. I suggest record keeping wise, we talked about earlier. Some folks want to keep those items they keep permanently in a safety deposit box at the bank. And those boxes generally cost you $70 to $150 a year. Rent, that safety deposit box rent is deductible as well. Tax preparers and collectors, when you are ready to get your taxes assembled and preparing your returns, some of us will just take that great big envelope to the accountant and say, well, here they are. And you've got every little receipt from McDonald's and Hardee's and gas stations and the clothing store and parts place and tires, and you just got it all right in there in one big envelope for them, 200 or 300, 400 pieces of paper. And you just hand it to them and say, here you go. Well, they're glad to get that. They are glad to get that. But here's what I want to bring you up to speed on. Accountants will be accounted for. And every piece of paper that's in that envelope, there's going to be a bill attached to it. Because they're going to pick it up, look at it, examine it, record it, and all this work that they're doing, every minute that they're working for you on every one of those bills, the clock is ticking and it's a dollar mark every time they're clicked. So what can you do to lessen the amount of your tax preparation cost? Is you do the summarizing yourself. You get all your bills in a stack and you put all your travel bills in one stack, all your medical bills in another, your gas bills here, your insurance bills there, your utility bills there, and you add them all up. Because the accountant, all they're after, all they want to hear is the summary or the total. They don't, all this adding up the little numbers, you can do that yourself or just bring in somebody that don't have to be really skilled to do it to help you summarize your taxes information. And then you're taken to the accountant. Of course, there are certain things they have to see that they want to actually see it and touch it, like your tax bills and things you get from the county or your W-2 forms or 1099s. They actually want to see them. But these other summaries of your other expenses, if you can give them a summary sheet, it'll save you a lot of time and save them a lot of money, and everybody's going to be happier. Now, I will assure you that if they need to see something else, they will ask for it. They certainly will. Another footnote here. A CPA by law signs their name at the bottom of your tax returns, and when they put their name on the bottom of it, they're basically saying and living up to their oath that they truly believe that everything in this form that they have attached their name to is truthful and legal. So they have an obligation sometimes to ask you some hard questions that you may have to come back and tell them things that maybe is going to cost you more money tax-wise or more work for them to do, but you have to do it. The option is to lie or withhold information, and that way the accountant's not going to want to serve you in the future, and that's not a good thing. So if you're working with a CPA, just know that they have the right to ask you some real hard questions. That doesn't mean they don't tell anybody, but they need to know it before they can sign the name on that tax form. They indeed may be able to help you work out another maneuver or another way to present what you're doing here that maybe won't cost you taxes. So don't think you know it all. That's why you're hiring folks to help you. Who are the people that are interested in collecting taxes? Well, at the city, it's the town clerk. At the county, it's the tax collector. In North Carolina, we call it the NCDOR, Department of Revenue. And the U.S. government is the IRS, or the U.S. Treasury, they like to be called. These folks are all about getting money to keep their organizations running. And we need to pay taxes. We need roads. We need the military. We need the Navy. We really need the Coast Guard. We need to help people that can't help themselves. There's so many reasons that, yes, we need to pay taxes. However, everything is not called a tax. Sometimes they call it a permit, sometimes a license, sometimes it's an estimate or some type of fee. But at any rate, I don't group them all in and call them tax collectors, okay? I'm happy to tell you that for sales and use tax purposes, you'll be dealing with the North Carolina Department of Revenue, home base Raleigh, but they have regional offices all over the state. And good news is they sometimes will come right to the small business centers and offer special classes with helping entrepreneurs. They're always giving these classes around the state, so Greg will be able to tell you, or you can go to their website and keep up with where they're giving webinars and seminars to help small business people with getting right down to the details. Here's the good news. The North Carolina Department of Revenue enjoys a great reputation of having good people, folks that are friendly and helpful, especially to entrepreneurs. So I want to tell you, you really don't have to be afraid of these folks. They're out here mainly to help you. Now, of course, when you try to screw them, they're not going to have any sense of humor at all, especially with not paying your sales tax or your use tax. But know that when you're after general information to help you get your business started, pretty darn good group of folks. There's your toll-free numbers there, your places you can find them online or easy to do. Let me suggest to you, pretty darn good bunch of folks. Different types of taxes might be for withholding, that's employee issues, different types of things that you would withhold from employee pay, privilege licenses, unemployment insurance, and franchise taxes. Congratulations, you didn't know you were going to get to pay a franchise tax, did you? Well, you are. And it's not because you own a McDonald's or a Chick-fil-A franchise. It's because if you're in business, the tax folks at the state government and federal government say, well, if we're going to handle these tax forms for you, you need to pay at least one tax, whether you're making any money or not. And they call it a franchise tax. So at the bottom of your form, you'll be paying between $25 and $150, depending on how big your business is, some type of franchise tax on both the state form and the federal form. Not a thing you can do about it, not any way to get away from it, so just know that it's coming. Your county taxes, I want to remind you, are all about assets, property that you own. In North Carolina, that's how counties make their money, is charging you taxes on the value of what you own. For businesses, it's kind of interesting. It covers all the things that are on that depreciation sheet that we talked about earlier. So when you fill out your county tax form, about the only document you need to use is your depreciation sheet. And I can tell you, you don't really need to hire a bookkeeper or a CPA to file your county taxes for you. You do need for them to give you an annual financial statement that's got a depreciation sheet on it. But every question that you have to answer for your county taxes is usually on that depreciation sheet in your financial statement or your federal tax return. How about that radar system there? Those auditors have a radar, and are they going to pick you out as a target? Well, heck no. Let's try to avoid that, right? Because it's no fun. I've had the privilege of sitting through a few audits in my years, and it's not fun. So, good news is less than 1% of taxes are audited. That's good news for all of us. But there's a few prying eyes. There's a few prying eyes that those auditors are going to want to come and look at. And generally, the reason they're coming and looking is because you and me made some dumb mistakes. And we put up some red flags that help that radar find us. I want to encourage us this afternoon of how to avoid putting up a certain number of red flags. So as a new business person just getting started, listen to me carefully here. The first red flag goes up with shady tax preparers. And these are the folks that have the yard signs up at corners and such as that to say, let us do your taxes and we'll guarantee you $3,500 refund. Or low tax preparation, high refunds. It's always about giving you some idea that if you do business with them, they're going to guarantee you're going to get some money back. Please don't believe that. Please don't believe it. Because what these folks are doing is they're going to adjust the numbers in such a way, whether they're real or not, that you're going to get a return. And when you come in to sign your forms, they don't say, okay, we got it all figured out, and you're going to get back $2,500. So you say, oh, man, that's great, and that's the only thing you look at is that $2,500 and where to sign. The other parts of all this is, with that $2,500, they maybe end up getting $1,000 of it themselves, and they've adjusted the numbers so that you show that you have a lot more deductions or a lot less money than you actually made. It's just plain fraud. So you'll get your refund check probably, unless the computer kicks it out first. Usually they'll send the refund checks back, and then they'll come around and ask that let's do an audit. And when you get into it, you see that you've taken advantage of the government, and they want their money back. They don't care that the preparer is gone to down to Mexico or up to Minnesota or wherever they went to. They don't care that they're gone because they're looking at you because that refund check was made out to you. So, does this really happen? Well, think about if you ever stay up at night after 11 o'clock and you watch the commercials, there's all these people that are talking about how they got in tax trouble. They had to go to Tax Funds Unlimited or something like that, somebody to help them get out of this $50,000 jam that they got themselves in, all this trouble they got in, or all the folks that are declaring bankruptcy because of tax issues. Lots of times, these shady preparers talk people into letting them do their tax forms and got the people left in big trouble. So, if you want to find someone to help you with your taxes, you check out their references. You talk to folks, make sure they've been around a while, and you can find them when you need them. Or better still, is try to find a bookkeeper and or a local CPA firm to help you with your taxes. Now, if you're just still doing your business as an individual, just with one income and not a lot of write-offs and things like that, there's not a thing wrong with using your computerized folks, H&R Block or other people who handle what I don't call not complicated returns. But when you get into business now and you start dealing with depreciation and loans, amortization, employees, and lots of different things, then you don't want to get someone with some expertise to help you that will stay with you. You see people going into court and you see them sitting beside their lawyer, and that lawyer brings them a lot of confidence, and everyone's encouraged to do that. But if you go to an audit and you did a shady preparer or whatever, you're going to that audit right by yourself. But if a CPA has helped you with your bookwork, usually the CPA will be going to that audit with you or helping you through it, and usually they don't charge you a penny. Some will, some won't. You can talk to your CPA about that. But that is one of the major advantages of doing business with a certified public accountant firm. Another thing that gets us in trouble is when we don't report our income. Eventually, you do it long enough and big enough, they will find you. They're pros at it. So not reporting your income, it can get you in trouble. Now, how much of it, whether you do 100% or you have some reasons you think you don't have to report 100%, but at least report enough income to keep the radar from finding you, and be ready to back up whatever you put on your form. Not filing your taxes on time, not filing them on time sometimes is necessary. A lot of us have to get extensions for one reason or another. Not necessarily the extension that we get from the federal government and the state, but those that we get from the county government. So let's talk about this a minute. In county government, in business, you're going to get a tax filing form. Every business will get a form that you're supposed to file your taxes with the county during the month of January. Usually that form is mailed to you as a business person the last week in December. You need to file that form back to the county before January 31st to avoid having to pay a 10% penalty on your taxes. Well, as a business person, most of the information you need to put on that form is going to come from your accountant on the depreciation sheet, and almost no accountants are having their customers' tax returns finished by January 31st. So here's what you need to do. As soon as you get that tax form from the county, you go on their website, and every county in the state has a website for their tax folks. And on that website, there's a place that says Corporate Tax Filing Extensions. You click on that block, you type in your business name, and they will automatically send you an email back that says you've got an extension to April 15th, because they understand what's going on. All right? But if you don't ask for that extension, and it's easy to do, then when you do file your taxes, whatever is owed, there'll be a 10% penalty added to it because you didn't ask for that extension and you filed late. Let's talk now about your business priorities. We don't have to pay taxes if we don't make money. It's a lot better to make money, right? So let's think about what we can do starting now in April 2022. What can we do in our business to make sure that we're going to be bringing in more money and hopefully more profits? The first thing I want to ask you to do is to consider looking at how you're offering your services to your customers. And if it is simply take it or leave it. In other words, you've got your pricing structure in such a way that it's either you take it or leave it. Then I don't share with you that 85–90% of your customers may be deciding to leave it and go look for a better deal. But if you project your pricing in such a way that says, this is the price on it, but we can work with you. We can use credit cards, or we got a sale going on, or maybe you can handle delivery yourself. In some way, let the customer know that you've got some options that will make them stick around and take a second look and do some talking to you. Now, in a couple of weeks, we're going to be having a webinar on how to price your products. I want to encourage you to attend that, because we'll get into all the things that you can do rather than just saying take it or leave it. I use the term raving fan customer, the RFC, and that's the customers that really like doing business with you, that go out and tell the rest of the world to do business with you too. You can create your raving fan customers. What does that tell us? It says that every customer is important. We don't take any of them for granted, and we do what it takes to make sure that when we have a chance to do business with someone, we're asking them to be happy. We want them to be 100% satisfied so that they'll come back to see us. New businesses need repeat business. I want you to have a database. I want you to have a way to reach out to your customers on a regular basis to remind them that you're here, that you've got some great services and products to offer, and you're hungry. You need for them to come and spend money with you. And you reach out to them with your database. So if you don't have that, then let's find a way to help you get into it. 85 to 90% of the people shopping today in any kind of shopping are doing it on their telephone. They're using their telephone screen right there to shop for people to do business with. They see your presentation on their telephone on what is called a mobile page being projected to it through your website. You can't have a mobile page without having a website, a Google My Business account, a YouTube channel, or a Facebook account that's got a mobile page done to it. But the bottom line is, a mobile page has to be designed to be easy to use on the telephone. Otherwise, you get a page that's hard to navigate. You got to pinch and spread, and you can't read. And it really doesn't encourage someone to call you up or to send you an email. So spend some time thinking about, how does your mobile page look? So how do you do that? Pick up your telephone, go to Siri or Safari, and type in your business name and see what comes up. You may be surprised. What you want to come up is what you want to see what your customers see, so you'll want a powerful mobile page to help people do business with you. And if you don't have a Google My Business account, then you need to get one. Because what that does for you is, whether you have a website or not, whether you are active on social media or not, a free Google My Business account can put you in the mainstream of doing business on the internet, because it helps customers who are searching for you or your products find you